So today on the Accounting for Our Community podcast, we have Christine Mills, partner of Assurance and Advisory at SB Partners. Thank you for joining us today, Christine.
Thank you for having me.
So a little bit about Christine. Christine worked for a national firm for 12 years before joining SB Partners. And now Christine works primarily with owner-managed businesses in a variety of different industries, including retail, manufacturing and distribution, logistics. What Christine really enjoys most is helping her clients, learning about her clients' operations, and seeing the impact that they're making in their community. Christine also serves on the board of governors for Hillfield Strathallan College. And thank you very much for joining us today.
Thank you.
So the topic of real estate has been, ever so much trending over the last few years. Now, we're definitely seeing a dip in the market and interest rates are happening, but I think the most important thing anyone who invests in real estate, even if it's your primary residence, must know is what are the tax considerations that you need to think about, because real estate is often someone's biggest asset. So today, Christine's going to help us kind of go over those questions and let us know, what those tax implications might be. So on a primary residence, Christine, what are the tax implications?
So there's a few things to know and to consider. The first is that if you own your home and it's the only property you own, CRA allows an exemption if filed in your personal tax return, such that the capital gains on that property would be exempt from tax.
Right.
There are specific criteria that the property needs to meet, 4 in total. One, that it's actually a dwelling where you could live, so it's not a shed or some other building on your property. You actually lived there for part of the year.
Okay.
You own it, and you actually claim an exemption on it.
Okay. And so is that the principal residence exemption we're talking about?
That is the principal residence exemption.
Okay.
Yes.
Perfect. And so is your entire property exempt in this principal resident exemption?
So if you own a home in a suburban neighborhood or a condo in downtown Toronto or somewhere, yes. Generally speaking, yes. However, if you're in the country or in a more rural area, you need to really be aware of what's called the half-hectare rule.
Okay.
So essentially, CRA is allowing the exemption for the house itself, the dwelling, as well as 1/2 hectare, which is approximately 1 acre. Anything above and beyond that technically is subject to tax.
Really?
Yes, and a lot of people aren't aware of that. But there are some exemptions to get you, or some other considerations that would allow that excess land to be included as part of your principal residence.
Okay, and what would that include?
So if, for example, your driveway goes through the excess land and there's no other access point to your house, no other spot where the driveway could be, that would be something that would allow that excess land possibly be included. Additionally, you need to be aware of zoning laws, bylaws within your city, town, county. If there are restrictions on, for example, your excess land is not allowed to be subdivided, right?
Okay.
So someone else could not build another house next to it.
Right.
You back onto a ravine or something like that, then there's often restrictions on what can be done with your land. So all those things need to be considered in discussion with your accountant.
Right.
And if you are able to, if you think you satisfactorily meet all those exemptions, then possibly that excess land could be included, but it needs to be looked at.
Right.
If it can't be included, what that means is you need to allocate a portion of your purchase price and your selling price between the house and that 1 acre, as well as the excess land.
Right.
To actually calculate the amount of capital gain that could be taxable.
Right. So if you have a property that's over 1 acre, this is something that you need to be considering.
Something that you need to consider, something to talk to your accountant about probably shortly after you make the sale.
Right.
Because you don't want it to come April and then all of a sudden you have a tax liability that you didn't plan for.
Right. Right. No, that makes sense. That's good information. I would have never considered if I had my primary residence on, a few acres of land that I would have to then include that.
Right.
So,
Many people just assume it's my house, I live there, I'm exempt, but you need to consider those things.
yes, and having that tax planning in advance, so to your point, you don't have that liability sneak up when you go to sell.
Right.
Yeah.
Right.
Awesome. So what happens if there's a change of use in your property? So let's keep using this example of, you live on a few acres, or maybe you have a hobby farm. Like, what would happen in that example?
So in an example, let's say you owned a home, right? And you decided, I'm going to go traveling for a year, and I'm going to rent my house for that year. I don't want to totally sell it because the market is so unpredictable. I'm going to rent it, right? CRA deems that a change in use and a disposition.
Okay.
So you need to actually record that disposal in the year that change in use happened. You can claim the principal residence exemption on the disposal, but you are deemed to have that disposition. And then for the period of time that it was a rental property, it is not your primary residence.
Right.
So you're allowed to claim a principal residence for one property a year. Okay. And if you remember the 4 criteria I spoke about in the beginning, you need to actually reside in that residence for a portion of the year. So if you were to rent for an entire calendar year, that property would not be your principal residence for that year.
Right. So basically, if you wanted to then sell, you can't claim it as your primary, but if you then decided, okay, I'll come back and live in this home,
right,
then you can change
that. Or if you were to come back and sell, you get the primary principal residence for the majority of the time that you owned the property, just not for that 1 year it was a rental.
Right. Good to know. So what if you own more than one property?
So any property can be your principal residence if you're there for part of the year. So if you have a cottage and you go there in the summer, you're there for part of the year. It's a dwelling, you own it, you meet the criteria.
Okay.
But because you can only have one, you need to pick.
Right.
So in a year that you dispose of one of those properties, that's when you make that decision.
Okay.
And generally you make the decision by what property has appreciated in value the most over the time that you owned it.
Right.
So again, you need to talk to your accountant. You need to get information on both properties, based on when you bought them. You're selling one, which is a triggering event, but you probably need to know the fair value of the other one as well.
Right.
To determine which one has appreciated the most.
Right.
And then talk to your accountant and determine which one you will claim the principal residence exemption on.
Right. So it's not as easy as you go list your house and sell it. There's a lot of considerations before.
Right.
Perfect. So what are the ownership considerations for non-principal residents? So let's use that
cottage. The cottage, right?
Example.
So if you have a cottage and it's your vacation property, and you are using it, it really should be owned personally by you, not within a corporation.
Okay.
Many people want to be able to use corporate funds to buy this vacation property.
Sure.
But unfortunately, if you're using it, you're really a shareholder of the corporation and you're receiving a benefit from that corporation.
Right.
Which means that a taxable amount should technically be added to your, whether you get a T4 or on your personal tax return. And it's all based on the fair market value of that property. So your use of that property, you're receiving a benefit, and it could be quite high. And when you consider the length of time that you're going to own the property, the number of years that additional income inclusion would have to be on your personal tax return, it really does not make it tax efficient in the end to buy it through the corporation.
Right.
So an accountant can run those calculations for you, but our advice is always, if it's your property, you're vacationing there, you should own it personally.
Right. So no corporations.
No corporations. No.
You heard it here first. And what about, I own a home in Florida that I like to go visit.
Right. So if you have a vacation property in Florida, and this is a very common question, how should you own that property? The answer to this question is it depends.
Okay.
You need advice from a U.S. tax professional as well as a Canadian tax professional. And some of the things that they will consider are the total value of your actual estate.
Okay.
Because in the U.S., they have very specific rules around estate and gift tax.
Okay.
They're very specific, so I'm not going to get into them here, but I would say you need to take that into consideration when you're purchasing a home. If you have a very large estate, and I would say over $12 million or so. $12 million is the current exemption limit for estate tax in the U.S. So if you think your estate is around that, you need to talk to tax professionals first. Generally, the common treatment is to put the property in a Canadian trust, but you should get professional advice before you just go ahead and do that.
Right. Okay. That's good advice. So again, talk to your tax, your accountants, your tax professionals before going and buying property, because there are a lot of tax planning considerations that you need to take into account. And just for example, in question 1, when we're talking about the excess land, you would never consider that, but it could trigger.
It could. And you know what? And these are generally short conversations. They're not long and involved, but it's good to have the check-in with someone who knows your entire financial situation, right? So, a lot of people talk to other people and someone else has told them, oh, I bought my cottage in a corporation, or I just claimed the principal residence. Well, that's great. But if you, for example, claim the principal residence exemption and maybe you didn't put it on your personal tax return, well, then technically there's a risk there that under audit it could suddenly become taxable.
Right.
So you need to keep your accountant informed. You need to have these conversations with someone who knows the full financial situation, not necessarily, your friend at the coffee shop.
Yeah. Yes. Now, rental properties. That has become very big over the last, number of years. What are the considerations there? What if you earn rental income?
So rental properties, again, there's always different things to consider. But if you are owning a property and you're renting it out, whether it be residential, whether it be commercial, and you're not using it at all for personal use, generally we do say put it in a corporation.
Yeah.
Mostly, and it's not really for tax reasons. The net tax to the shareholder ends up being roughly the same at the end of the day. But it's more liability and legal reasons, right? So if there's a slip and fall in the property, if someone decides to get litigious, it's better to have that property in its own corporation where that is the only asset that potential lawsuit could access.
Right.
Yeah.
Now, what if someone owns a home and let's say they rent part of their home and live in the other part?
Right. So you essentially have a mixed use property there.
Okay.
In that scenario, you have to claim that rental income on your personal tax return. And obviously there's certain things you can deduct against it. Property taxes, repairs and maintenance, insurance for that portion, all of it for that portion of the property. It does mean that when you go to sell it, you have a personal use portion and an income producing portion. So the principal residence exemption would only pertain to the personal use portion.
Right. Okay. Good information to have. Is there any other considerations or trends that you're seeing right now, or advice that you would want to give to anyone considering using rental income or rental properties within their portfolio?
Only that people are moving very quickly, right? People are moving quickly and people are forgetting to ask these questions. And that's why it's important. Because of the way the market has been, people have to make decisions quickly. And that's fine. Make the decision, but then take this next step to know the full implications of the decision.
Yeah. Good advice. Good advice. Yeah. Well, thank you for your time today, Christine.
Thank you.
Moral of this story is if you're purchasing property, even if it's your primary residence, speak to your accountant, speak to a tax professional, because there are considerations that you need to think about.
Yes. Thanks for having me.